Hello everyone and welcome to this video in which we're going to discuss EY's comment letters on two exposure drafts that the International Sustainability Standards Board, the ISSB, developed and which were recently open to public consultation. My name is Michiel van der Hof and I lead EY's Global Corporate Reporting Services. I'm joined by Luci Wright, who's also part of the global team on sustainability matters. And together we're going to share with you a high-level overview of how EY has responded to the ISSB's exposure drafts on S1, General Requirements for Disclosure of Sustainability-Related Financial Information, and S2, Climate-Related Disclosures. We're recording this video in August 2022. Today's session will not cover the specific contents of the exposure drafts themselves, but will instead focus on the comment letters that EY submitted to the ISSB on July 29th, in response to the specific questions posed in the exposure drafts. By the way, our comment letters can be found on ey.com/IFRS and are available for everyone. We submitted two letters, one for S1 and one for S2, and they are quite lengthy. But Luci, in our experience, the fact that they're lengthy does not mean we disagree with the ISSB proposals, right?
That's right, Michiel. We mainly state our support for the proposals and reiterate in our cover letter to the ISSB that the length and the volume of our responses is more a consequence of the number of detailed questions posed in the two exposure drafts, as well as our desire to provide the ISSB with really good feedback. So our letters do indeed go into quite a bit of detail and are quite comprehensive.
And you make a good point, Luci, because people will note that we include in our comment letter a cover letter up front, where we summarize our overall comments and views. And then we include a detailed appendix that answers individual questions posed by the ISSB about the proposed requirements. If people would like to get a general idea of our views, then reading the cover letter is likely sufficient. Luci, the ISSB proposals are aimed at investors and focused on enterprise value. What do we say about that in our comment letter?
Yeah, so we support this view, Michiel. We also recognize that investor needs and sustainability issues will evolve over the longer term. And this then ties into this concept of dynamic materiality. And this means that sustainability topics that are relevant or significant or material can evolve over time, and they can even change to something completely different. So it's important for investors to understand this concept of materiality, and we highlight this point in our comment letters.
Dynamic materiality, and why can these topics change over time?
Well, not all sustainability issues that may be relevant to an entity now, or an investor even, will be relevant in the future, and also vice versa. So we don't necessarily know what current topics will be relevant if the entity's circumstances change, whether that's local or global. And we think about the pandemic, for example. Nobody could have foreseen that, and it had a huge impact globally. Another example is at the moment we have a strong focus on greenhouse gas emissions or GHG emissions, but there are also other issues coming out like human rights and things like that. So there's lots to be keeping an eye on.
The materiality concept as understood and applied in sustainability reporting is different from what we're used to for financial reporting, where you generally take a percentage of pre-tax income or equity. You also mentioned materiality, relevance, significance. What are we saying about those in our comment letter?
So these terms are all used throughout the two exposure drafts. Our understanding is that significant relates to the identification of sustainability-related financial risks and opportunities insofar as they relate to the entity. But material relates to the information that the entity would disclose about those particular risks and opportunities. But we think perhaps that this distinction is not always clear, and that it may cause confusion for entities when trying to interpret and apply these requirements. So we've asked the ISSB to provide a definition of what significant means, as well as some additional guidance around significant and how it should be considered in the concept of other terms like materiality and relevance.
Okay, and the ISSB proposals are built upon the established Task Force for Climate-Related Financial Disclosure Framework, TCFD, which is centered around four core themes: governance, strategy, risk management, and metrics and targets. Do we support this?
We do. The TCFD framework is already well known and it's applied in many jurisdictions.
And the ISSB proposals also refer to greenhouse gas protocol. Do we support this?
We do. We support the reference to the greenhouse gas protocol. However, we do realize that this protocol was developed more than 20 years ago. So we encourage the ISSB to engage with the authors of the protocol as a matter of urgency, really, to make sure that the protocol remains fit for purpose in the current context of the requirements. And this is also a more general comment to the ISSB regarding the reference to external frameworks. It would need to come up with a solution to engage with the relevant bodies to make sure that these frameworks and standards are maintained and updated. This is especially important because they are outside the remit of the ISSB's due process.
Right. We also discuss Scope 3 greenhouse gas emissions, which are typically more complicated in terms of greenhouse gas accounting and disclosures, given that they're essentially an entity's indirect emissions. That is tied to indirect emissions occurring across an entity's value chain, for example, from purchased goods or services, business travel, upstream and downstream transportation, investments, etc. What are we saying about Scope 3 requirements? Do we support them?
We do. We support the disclosure of Scope 3 greenhouse gas emissions, but we suggest that they are part of a phased-in approach. In other words, we're saying that they are not made mandatory right now, to give entities a little bit more time to set up their processes and their controls needed to gather the information. And in addition, entities need to get information about their value chains, and that is outside the boundary of the traditional reporting entity that we're used to dealing with in IFRS. So collecting this external data from suppliers, from customers, and so on might be quite challenging in the intermediate term, especially if you want to get good quality data.
Right. And we also encourage the ISSB to continue to engage with other standard setters, such as the Securities and Exchange Commission, the SEC in the US, the European Financial Reporting Advisory Group, EFRAG, in the EU, and we refer to the building block approach. What do we say about that?
So we essentially recommend that the ISB continue to engage with other standard setters to help them in developing standards that can serve as this global baseline, upon which local jurisdictions can then build upon. So they can put in additional requirements that are relevant to their jurisdictions. So this approach requires a baseline then that is truly comparable and suitable to be used alongside any specific jurisdictional requirements.
Right. This is indeed an important consideration, as it would mean a lot of extra work for entities which operate in multiple jurisdictions if they have to navigate entirely different requirements. It would also be difficult for users and preparers of information if, say, reporting on the same metrics, such as greenhouse gas emissions, produce different outcomes in different jurisdictions as a result of different approaches. It would be very complex indeed. Let's have a look at S1, which is more a framework type of draft standard. We compare it to the existing ISSB's conceptual framework. What do we say about that?
So we support the idea of a framework for sustainability disclosure standards, but we find that S1 is a little bit confusing because it includes some of the same principles as you find in the existing conceptual framework, but it also introduces some other principles in its Appendix C, which are not in the conceptual framework.
So we're asking the ISSB to provide some additional clarity about the principles contained in Appendix C of S1 that you were referring to, and in particular how this relates to the existing conceptual framework used in financial reporting. And we suggested that the ISSB consider amending the current conceptual framework to apply to sustainability-related financial information too. We think that this would be an efficient solution. On a different topic, Luci, is the term reporting entity clear enough? That is the reporting entity for sustainability information the same as for IFRS financial statements?
So it's a good point because we actually note in our comment letter that it's not entirely clear whether the reporting entity follows the control concept as used in the IFRS financial statements, or whether it includes a broader concept with the value chain included there. So we believe aligning with the control concept in IFRS is a good idea, but we acknowledge that the use of a broader concept in certain cases might be more relevant, but it could be used rather as an exception. For example, when it comes to greenhouse gas accounting, the protocol allows for 3 different approaches: the financial control, the operational control, or the equity share approach, and then an entity can choose which to apply.
Right. Another topic that is addressed in S1 is change in estimates. In the sustainability standards, it's being proposed that estimates are changed retrospectively, so adjusting comparative information, compared to IFRS accounting standards where estimates are changed prospectively. What is our view on this?
So this is a tricky one, but in our comment letters, we agree with the proposal to retrospectively adjust comparative figures as a result of updates and estimates. And it is obviously very different to what we do in financial reporting. Although we can foresee some potential problems arising because entities are not that familiar with the practicalities of using such a different approach, we believe that in the context of the sustainability world, it makes sense to adjust past comparative figures because we've got targets, for example, which are set according to certain baselines, and those baselines need to be updated to reflect changes, and therefore that has the influence on the targets. So that said, we emphasize in our comment letters that it is really important for an entity to understand the reasons why it is going to be different in sustainability reporting versus what we do in financial reporting. The difference between the different kinds of estimates, for example, what is an error versus an estimate, and also the cost-benefit trade-off for doing this work.
Right. We also include in our comment letter for S1 that we agree that there's no mandatory location of where sustainability information should be disclosed, but we further highlight that a more consistent approach should be considered over the longer term. And we comment on the effective date of the proposed standards, where we suggest that the ISSB consider aligning the effective dates of S1 and S2 with the dates of other major sustainability-related disclosure frameworks, such as the SEC in the US and the European standards. As discussed earlier regarding Scope 3 greenhouse gas emissions, we also suggest phasing in these requirements over time. Luci, what do we say about interim reporting?
So the proposed standards include some disclosure requirements for interim reporting, but we don't think these requirements are sufficient if an entity has to prepare interim reporting. So if you have a look, for example, as interim reporting requirements under IFRS are very extensive. So we ask the ISSB to further expand on the content of those interim sustainability-related financial reporting requirements.
And in order to get a better understanding of the ease of applicability of the proposed standards, we also suggest to the ISSB to perform field testing before finalizing the standards. Let's switch gears a bit and discuss S2, which covers climate-related disclosures. In our cover letter, we discuss some of the areas where we're supportive of the proposals. Could you tell us a bit more about these areas?
Yep. So we briefly discussed Scope 3 GHG emissions earlier, and we obviously believe that they constitute an important part of the puzzle regarding tackling the climate crisis. We know already that a lot of entities are reporting on Scope 1 and 2, but Scope 3 emissions are very important, and they're often a very large source of emissions. So we are supportive of them being included as a mandatory reporting requirement. But we have made the prior comment that entities will need some time to prepare for these disclosures. The proposed requirements also include guidance on scenario analysis to help investors assess the resilience of an entity's strategy to climate change, as well as the disclosure of an entity's transition plan. And there are 7 cross-industry metrics that an entity would be required to disclose on, and this would help contribute to much more comparable information across all entities. Now, S2 also includes an Appendix B, and the Appendix B contains industry-specific topics and metrics that in a large part draw from the industry metrics that were developed by the Sustainability Accounting Standards Board, or the ISSB, and the ISB have tried to internationalize and update these. Now, while we're supportive of industry-specific content and requirements, we do highlight some concerns in our comment letter regarding the content and structure of Appendix B. We suggest that the ISSB address some of these concerns before requiring Appendix B to be mandatory. That said, though, we do see the value in using Appendix B as illustrative guidance that entities can use to help them identify their climate-related risks and opportunities.
Okay, so to summarize, for now we support the inclusion of Appendix B with industry-specific topics and metrics as illustrative guidance, But in the longer term, we can foresee supporting the mandatory adoption of Appendix B once the ISSB has gone through the guidance in more depth and worked to reconcile the content and structure in a way that will facilitate ease of adoption and implementation for entities. We also recognize the ISSB's efforts to incorporate a degree of flexibility in the requirements, for example, allowing alternative techniques for scenario analysis, which we believe strikes a balance between the cost of implementing the requirements and the benefits produced. It also fits nicely within the content of the building block approach, which we touched on earlier. We outlined in our comment letter that some areas we believe warrant some additional clarification, such as key terms used, material, significant, relevant, etc., that we spoke of earlier, as well as the term climate related, which is open to a fair degree of interpretation and has implications in terms of what the scope is covered by the requirements. And also we call for greater alignment between the terms used in the exposure draft as compared with how these are defined according to IFRS accounting standards. And again, materiality stands out as a prime example of similar yet very distinct concept between accounting and sustainability reporting. We also refer to challenges regarding to future-oriented information, Lucy. Are you able to explain this in more detail?
Yeah, well, the proposed requirements call for disclosure over the medium and long term of the anticipated effects of sustainability-related and climate-related risks and opportunities on an entity's financial position and its financial performance, and on its climate-related scenario analysis. And all of this is going to be really challenging to assess, especially quantitatively. There's not always a direct relationship between a significant risk or opportunity and the financial position. So the challenge associated with clearly distinguishing sustainability-related and climate-related effects from all the other effects on an entity's financial position could actually impact the reliability of the information and the ability to verify future-oriented information. So recognizing these challenges, we have asked the ISSB to provide additional illustrative guidance and or examples to assist entities.
Okay, and EY also provided a response to the proposed US SEC requirements on climate-related disclosures and to the proposals of the European EFRAG on sustainability reporting. Would you say that our comment letters to the ISSB on the exposure drafts are consistent with the topics discussed in EY's response to the SEC and EFRAG?
Yes, although the proposed standards obviously differ in certain respects, our responses to these consultations are very similar. For example, the SEC, EFRAG, the ISSB proposed requirements are all grounded in the TCFD pillars, which we've already talked about, and we support that. Another example is that the SEC, EFRAG, and the ISSB all make reference to the greenhouse gas protocol in their requirements, and that's another similarity. Of course, we're also supportive of that. A common theme throughout the responses is that we ask all of these three standard setters to continue to coordinate their efforts in order to help achieve the goal of creating this global baseline of requirements that we talked about earlier.
Thank you. To summarize the key messages discussed today, we're broadly supportive of the ISSB proposals and include several suggestions to the ISSB for them to consider when finalizing the standards, which are expected to be finalized early 2023. As I said earlier, our comment letters can be found on ey.com/IFRS. Both Lucy and I thank you for listening in and wish you a great day. From London, Luci Wright, Michiel van der Lof. Thank you.